This presentation is for people who are not essentially from an internal audit background, but who want to start with internal audit and internal controls. To take you through some of the basic definitions, concepts, I have taken an example from everyday life. If you look at this picture, there is a road with moving traffic on it, and there is a person who has to cross from point 1 to point 2 by moving through the road. To look at it from an internal control perspective, let's first look at the objective. The objective of the person here is to safely cross over from point 1 to point 2 in, let's say, about 45 seconds. In terms of the risk, anything that would defeat the objective, either partially or completely, will be a risk. And that risk could be because of external factors, that is, the vehicles on the road, the drivers driving those vehicles, or it could be because of internal factors, that is, something going wrong with the body of the person while he's walking or crossing the road. Now, if you look at the overall environment, what guides everyone here? Those will be the laws and regulations, the traffic rules, the road safety guidelines, the signboards to prevent accidents. Right. Now look at this picture again and notice the missing items from a control perspective. You'll see that there are no traffic lights, there is no traffic cop, there is no zebra crossing, there is no standby ambulance. Right? Now let us relate this picture to some of the definitions that we see. Let's come to internal controls first. Internal controls are the steps that enable us to achieve our objectives in an efficient and effective way while managing and mitigating the risks. Now, if you look at the traffic lights, the traffic cop, the zebra crossing, the standby ambulance, all these are nothing but examples of internal controls. Within the internal controls, there will be some preventive controls, there will be some detective controls, there will be some primary controls, there will be some secondary controls, there will be some design gaps, there will be some operating inefficiencies. Let's look at preventive first. Preventive controls are those which help us to prevent undesirable and unfavorable outcomes. The traffic lights here are nothing but preventive controls. Detective controls are the ones to detect if anything undesirable, example, a loss has happened. In this case, a traffic cop or a standby ambulance could be detective controls to see if there is some accident that has happened or any laws or regulations are being broken. Right. Now come to primary controls. What are primary controls? These are typically the first in line on which you would place your most reliance. Let's say in this example, the traffic lights. These could be systems or your technology in place. That is the reason you say these are primary controls. And what are the secondary controls? These are the controls when the primary controls are not working, you rely on mitigating or secondary controls, which help us or which ensure achievement of the objectives. Now, what are automated controls? Automated controls are those controls which are systemic, typically computer controls. Let's say in this scenario, what is a systemic control? It's a traffic light, which is something systemic, something which becomes red on a given frequency, then a yellow, and then a green. That is something which is driven by logic. And what are the manual controls? Manual controls are those which involve human intervention. Let's say the traffic cop here is a manual control. He's not guided by an algorithm. So let's say if there is no traffic light here, that clearly is a design gap. To mitigate that design gap, there is a traffic cop in place, and that traffic cop fills up for the absence of a traffic light. Typically, you would have seen this in an Indian scenario. Now, if the traffic cop is there, but he's not doing his duty, or he's not coming there on a fixed frequency, or if he's there, but he's not ensuring adherence to laws and regulations, that is an operating inefficiency. Right? So that scenario covers basically the overall concept of internal controls, or let's say the preventive detective controls and some of the automated and manual controls. Now that we've seen an everyday life example, let's look at what some of the textbooks say. Looking at Standard on Internal Auditing 120 from the Institute of Chartered Accountants of India, internal controls are essentially risk mitigation steps taken to strengthen the organization's systems and processes, as well as help to prevent and detect errors and irregularities. Internal controls are systemic and procedural steps adopted by an organization to mitigate risk, primarily in the areas of financial accounting and reporting, operational processing, and compliance with laws and regulations. Internal controls generally operate with human intervention, manual controls, but in an automated environment, computer controls are deployed to secure the systems and called IT general controls. Example, access controls, or check transaction processing at an application level and called application controls. Example, sequential numbering of invoices typically happens in an ERP. Now, if you were to relate back, these are the terms which we discussed in the last slide, looking at from a layman's perspective who's just crossing the road and evaluating what is a primary control, what is a secondary control, what is a risk mitigation step, what is preventive, what is detective. The only difference that is there in the previous slide and this slide is that this is with reference to an organization, and that was with reference to a simple example of an individual crossing the road with a clear objective in mind, with clear risk linked to the objective. Here also the commonality is, in any organization there will be clear business objectives, and linked to those business objectives will be clear business risks, and those risks will be mitigated through internal controls. Also taking a look at SIA 315, which defines internal control as the process designed, implemented, and maintained by those charged with governance, the management, and other personnel to provide reasonable assurance. Note it, reasonable assurance. It's not an absolute assurance about the achievement of an entity's objectives with regard to reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets, and compliance with applicable laws and regulations. The term controls refers to any aspects of one or more of the components of internal control. Like we saw in the previous example, there were different aspects of the same control which served the same objective, so that the person could safely cross the road from point 1 to point 2. But those were different types of controls. Now looking at from a business perspective, prevention aspects. Preventive controls attempt to deter or prevent undesirable acts from occurring. They are proactive controls which help to prevent a loss. Some of the examples you would see in any business would be segregation of duties, authorizations, approvals. Now looking at detection aspects, detective controls attempt to detect the undesirable acts. They provide evidence that a loss has occurred, but they do not prevent a loss from occurring. Some of the examples, most common examples you would see in a business: variance analysis, reviews happening, reconciliations, and even internal audit. Let's look at the definition one more time and extend it to a few of the examples in a business scenario. Preventive controls, by definition, are designed to provide reasonable assurance. It's not an absolute assurance, but a reasonable assurance that only valid transactions are recognized, approved, and submitted for processing. Therefore, you would see that many of the preventive controls are applied before the processing of activity occurs. In most situations, preventive controls are likely to be more effective in a strong control environment when the management authorization criteria are well defined and properly communicated. Now, by the definition, control types, preventive control could be manual or preventive controls could be systemic. Like we saw in the second slide, preventive control being a traffic light, it's a systemic control. Preventive control being a traffic cop is a manual control. Some examples in a business context: preventive controls include segregation of duties. It's a preventive and a manual control where the entire chain of transaction is not executed by a single person. There are multiple, 2 or 3 or even more people involved doing various roles to ensure that duties are appropriately segregated, and access to the system to execute or change the transaction is allowed only to authorized personnel and not to everyone in the organization. Again, this is a preventive control, but because it is controlled by the system, it is a systemic control. Physical safeguard and access restriction controls, those could be to physical information assets or to, let's say, physical entry into a data center. That's also a preventive and a manual control. Effective whistleblowing process, that's also a preventive and a manual control. Somebody trying to do something wrong in the organization and another person raises an alarm or raises a concern that something wrong is going to happen. That's a whistleblowing process, and it's also a manual and preventive control. And finally, a look at the detective controls. Detective controls by definition are designed again to provide a reasonable assurance and not an absolute assurance that errors and irregularities are discovered and corrected on a timely basis. Detective controls normally are performed after the processing of transaction has been completed. They are particularly important in an environment that has relatively weak preventive techniques or preventive controls. That is, when front-end approval and processing controls or even the systems do not provide a reasonable assurance that unacceptable transactions are prevented from being processed, or they do not assure that all approved transactions are processed accurately. In such cases, after the fact controls or the detective controls become more important in correcting the errors. By definition type, again, detective controls can be manual and detective controls can be systemic. Let's say one example is reconciliation of bank ledgers with bank statements. It's a detective control, manual control. This can also be an automated depending on the type of system you have, and if the system is automatically doing it these days, this could be detective and automated as well. Again, reconciliation of interface amounts exiting one system and entering another. Let's say your SAP is integrated to another system and data is flowing from one system to another system, and there is a detection mechanism which says that some of the entries which are appearing in a particular ledger are not reconciled. Again, it's a detective control, but because it is driven by the system and there is no human intervention in it, it's a systemic control. Another example, review of online access and transaction log. Example, audit logs. Again, it's a detective control, and audit logs being generated by your ERP system or your audit system. It's again a systemic control, but a detective control. I hope that these basic definitions and the example of a road with traffic light and moving vehicles will help you to understand uh, the definitions in a non-technical way. And once you've understood in a layman's terms or non-technical way, you should be able to break the jargons and simulate that particular example in a business environment. And as I always say in internal audit, I think two things are most important. One is the context and second is the sequence. I hope you like this and I hope you find my channel as useful. Please do subscribe to the channel if you like the videos, and there'll be more videos posted on this channel. Thank you so much.